We are live now, sir.
Good afternoon, friends. Today is the concluding date, the 10th day class for financial reporting. We have handled almost all accounting standards and we have just kept only a very few to take up along with India's 101 first time adoption. We will run through and at whatever point of time we are completing, we will conclude the class either a little early or a little later. Okay. So I think I just kept all areas covered. Let me just share the screen and we will start the session. Right. So it was on India's 19 employees benefits. We were having the discussion. Yesterday we are talking about defined benefit obligation and plan assets. Under that, I thought I will just try one problem before we could just take up to the next accounting standard. We have done 13, 14, and illustration number 15. And in that process, we will take up onto a new problem, which is considered to be a main examination question. And once in the recent past, they have asked this question. This is illustration number 24. Okay. Please give a good attention. Illustration number 24, RKA Private Limited is a old company established in 19XX. They are not ready to tell by what point of time. The company started with a very small capital base and today it is one of the leading companies in India in its industry. The company has an annual turnover of rupees 11,000 crores and planning to get listed in the next year. The company has a large employee base. The company provided a defined benefit plan to its employees. Following is the information relating to the balances of the funds, assets and liabilities as on 1st of April X1 and on 31st of March X2. Present value of benefit obligation at the beginning 1400 and at the end 1580. Fair value of plan assets 1140 and 1275 for the financial year ending 31st of March X2. Service cost was 55 lakhs. The company made a contribution of 111 lakhs to the plan. No benefits were paid during the year. There is considered a discount rate of 8%. You are required to compute the balances of the company to be included in its balance sheet as on 31st of March X2 and the amounts to be recognized in the statement of profit and loss account and other comprehensive income for the year ended 31st of March X2. Give the journal entries in respect of the amount to be recognized. So now let us just understand what exactly we are expected to do. So we have two things in our mind. One is present value of benefit obligation is the liability, fair value of the plan asset being the asset. Okay. See, now let us just, and we have the company which is having a turnover of 11 crores and they are planning to get the company listed and they are falling into India's 19. Now let us just look into what exactly we are expected to do. Illustration number 24. So by solving this, I think we should be in a position to complete this, giving a fair representation. When time is permitting, we will just give representation to other areas too. So number one, working on number one, so we have items like defined benefit obligation and plan assets. So opening and closing when you take up, the obligation is greater than the plan assets, 1400 and 1140, and at the close it is 1580 and 1275. Right. 1275. And you have net defined benefit obligation down to 260, and this being 305. So there is an increase in net benefit obligation, defined benefit obligation, to the extent of 45. This is number one. Then number two, the question what they asked is compute their balances. Compute the balances of the company. Say one moment. See, camera is off now. So for some reason, it is just, despite trying, so camera is off actually. So there is, you will not see the camera on there. So we will take up on to the discussion. So anyway, that we will take it up. The camera is used to be some other devices, what they are telling. Now, coming back to this discussion. So the question carries, compute the balances to be included in the balance sheet amount to be recognized in P&L and OCI. That we can just do. We'll prepare defined benefit obligation by balance brought down 1400 and 1580. Then during the current year, current service cost is taken up at 55 lakhs. By the interest on the net. Now let us just know about what is the interest on the net that you are just getting. Interest is computed at the rate of 8% on. So now let me just take the calculator. Eight on 260 on the opening net benefit obligation. Is approximated to 21. Right. So the difference shall be taken up as other comprehensive income 1580 and 1580. That comes to 104 balancing figure. Then comes plan assets Camera work பண்ணல. கொஞ்ச நேரம் இருந்தது அப்புறம் போயிடுது. To balance brought down 1140 by balance carried down 1275. So here the company made a contribution for amount of 111 lakhs to the plan. To cash 111. So we find the credit side is greater 1275. 1275 to OCI, that being 24. So net OCI is going to be 104 minus 24, which is equal to 80. The question what they asked is how much it will be affecting profit and loss account and OCI. So we can run through this with the help of a journal entry. So now let us just try find out as what journal entry that we would be passing for this. Excuse me, sorry. So the current service cost and interest 76 shall be debited to P&L account. Debit P&L account 76. Debit OCI 80. Credit cash is something that he had deposited into plan assets. And credit defined a benefit obligation net 45. Just check up. This comes to 156. This comes to 156. Read the question. Compute the balances of the company to be included in the balance sheet as on 31st of March X2 and the amounts to be recognized in profit and loss and other comprehensive income. Give the journal entries and respect of the amounts to be recognized. So in AS 19 for a fast track we have just completed. Right. Now we would like to take up now on to Ind AS 2. So Ind AS 2 is on to inventories. Inventories are to be understood as there are three divisions, subdivisions that we have. One is raw material, the other one is work in progress, the other one is finished goods. Raw material and work in progress are to be valued only at cost, whereas finished goods are to be valued at cost or NRV, whichever is lower. So, but generally people carry the message that inventories are to be valued at cost or NRV, whichever is lower, which is not the case. For raw material and WIP, only at cost. So for finished goods at cost or NRV, whichever is lower. Right. See, my video is not working. Somehow this, I'm trying to change that. Could not just make a change. Hmm? After that, just see. Hmm. One moment, I will just try to make that correction. Just you see. Hmm. After that. If I just put it on, it's not getting on at all. Hmm? So many are under the impression that it should be valued at cost or NRV, whichever is lower. For raw material, we do not have the intention to sell. NRV concept is not applicable. But however, in some circumstances, it can be taken up at NRV. That I will tell you, no. When raw material will be valued at NRV. See, now I will create a scenario, then through the scenario, you will be in a position to understand that. Raw material, I am just giving you through an example. Raw material is bought at rupees 20. And after our purchases, raw material dropped to rupees 15. This is one moment. So now I'm sharing it. So I was just trying to bring the video back. I cannot do that. See, raw material bought at rupees 20. After the thing, raw material dropped at 15. So whether it should be continue to value at 20 or 15 will be the question. So then if finished goods are expected to be sold at say rupees 145, where cost of goods sold is rupees 110. So when the finished goods in which the raw material is incorporated is sold at profit. This is what I will consider as scenario number one. Scenario number one, where finished goods are sold at profit, then raw material to be valued at rupees 20, the purchase cost. Scenario two, finished goods expected to be sold rupees 106. Cost of goods sold is rupees 110. Or I will put it this way, 101. Cost of goods sold, where raw material is to be valued at rupees 15. Because the finished goods in which this raw material is to be incorporated is likely to be sold at loss. Then raw material cannot be continued to be taken up at rupees 20, the purchase cost. There, the current replacement cost is the representative of the NRV for raw material, and that is a way we are expected to carry out. Right. So this is what we do have as a very important input with respect to the basic aspects of Ind AS 2. Now let us just try a few problems. And I consider as they're all very easy, quite easy. But thing is that there is always a chance that people might just go wrong. So only that such problems we can take it up. It is illustration number 2, we can take it up now. ABC Limited buys goods from an overseas supplier. It has recently taken delivery of 1,000 units of component X. The quoted price of the component was rupees 1,200 per unit, but ABC boss has negotiated a trade discount of 5% due to the size of the order. The supplier offers an early settlement discount of 2% for payment within 30 days, and ABC intends to achieve this. Import duties, basic custom duties of rupees 60 per unit must be paid before the goods are released through custom. Once the goods are released through customs, ABC must pay a delivery cost of rupees 5,000 to have components taken to its warehouse. So what are the items that we have got to take up? 1,000 units of component bought at 1,200 with a trade discount of 95%. So, trade discount of 5%. That means you are expected to take about 95% of 1,200, and the early settlement of cash discount of 2% to be settled within 30 days cannot be taken up as an adjustment towards the raw material cost. So therefore, we will take up trade discount but not cash discount. The import duties of 60 that has to be paid before it is to be released. That entire 60 for entire 1,000 shall be taken into account, and delivery cost of 5,000 has got to be taken up. So now let us just take up that. This illustration number 2. Basic cost 1,000 into 1,200. 12,000. Trade discount at the rate of 5%. 5%, 60,000 rupees reduction. Cash discount at the rate of 2%. Not applicable. Ignore. Then custom duty of 60. 60,000 to be added. Delivery cost of 5,000. So number of units 1,000. Cost per unit is rupees 1,205. That's it. Intention to take settlement discount is irrelevant. That we will not take up at all. Yeah, illustration 8 is considered to be a good illustration. Now let us just take up illustration number 8. In a manufacturing process of March Limited, one byproduct BP emerges besides two main products MP1 and MP2 apart from scrap. Details of cost of production are here and there. Raw material 14,500, 150,000, MP1 5,000 units, closing stock 250. Wages dash 90,000, MP2 4,100. Fixed overhead dash 65, BP 2,000. Variable overheads 50,000. Average market price of MP1 and MP2 is 60 per unit and 50 per unit respectively. Byproduct is sold at the rate of 20 per unit. There is a profit of 5,000 on sale of byproduct after incurring separate processing charges of 8,000 and packing charges of 2,000. Rupees 5,000 was realized from sale of scrap. Calculate the value of closing stock of MP1 and MP2 as on 31st of March X1. So they are asking us to find out the closing stock value of MP1 and MP2. And let us just know about what exactly had happened there. This illustration number 8. So we understand that they are bringing out through a joint process. And through this joint process, you have 3 products emerging. MP1, main product number 1, main product number 2, and there is a byproduct BP. Right. We have the basic concept of byproduct NRV is credited to the joint cost. So now let us just find out 2 important things in this process. One is working out number 1 is NRV of byproduct. So sale value, how many units they are selling, whether they have actually sold or not, how many products or how many byproducts units that they have developed. 2000 into what is the byproduct price? 20. So it is 40,000 as the gross sale value. Less. So there is a profit of 5,000 on sale of byproduct after incurring. See, that profit of 5,000 is not a matter that we should take up because we are taking up NRV. NRV is nothing but sale value minus cost to effect a sale. So therefore, we will not take into consideration the expected profit on byproduct. So separate processing charges of 8,000. They are not selling the byproduct just like that. So there is a processing cost. You have processing cost of 8,000. Then packing cost of 2,000. So 10,000 has got to be deducted and the net realizable value is 30,000. So working on number 2, join process cost. Join process cost. Raw material. What is it? Raw material 150,000. Then comes wages 90,000. Then fixed overhead 65. Then variable overheads 50,000. It is 3,55,000 as the gross cost. So from that, NRV of byproduct purchases of 30,000 that you have. Towards the end, you have to the extent of 5,000, which was realized by sale of scrap. See, apart from NRV, there is also a scrap that they are selling. That has got to be deducted. 5,000. So 35,000 has got to be deducted. So 320,000 is the joint process cost. Joint process cost 320,000. So this 320,000 need to be there is to be apportioned between main product MP1 and MP2. So apportionment of join process cost. So items are MP1 and MP2. Numbers are 5,000 and 4,000. Selling prices are 60 and 50. Sale value 5 lakhs. The joint process cost of 3,20,000 shall be distributed in that ratio. So it is 3 by 5 and 2 by 5. 3 by 5 and 2 by 5, 3,20,000 into 0.6, 192,000. 128,000. So join cost apportion. So per unit 192,000 divided by 5,000. 38.4 and 128,000 divided by 4,000, which is to be taken up as 32. So the question what they've asked is, what is the closing stock of MP1 and MP2? So closing stock MP1 number of units being 250. 250 into 38.4 plus 100 into 32. 250 into 38.4, then 100 into 32, all that comes to 12,800. There can be no better problem that you can have in Ind AS 2 on inventories. So with that, we can tell that Ind AS 2 is getting over. Now let me just check up through our past notings, the accounting standards that we have completed today. That is, we are giving importance to them. Yeah. So we have just done 2, we have done 19, we have done 8, we will be doing, and 24 we will be doing financial instrument consolidation over and 101. Right. So now let us just take up on to 8 now. This is in page number 48. We have Ind AS 8. Now let us just move on to accounting policies. Changes in accounting estimates and errors. Previously, we used to have in AS5 ordinary item, extraordinary item, prior period item, changes in accounting estimates and changes in accounting policies. So here it is about accounting policies, changes in accounting estimates and errors. What exactly is the main area that we have got to take it up? So here in our institute study material itself, they have mentioned that accounting policy would mean selection on application of accounting policy, consistency, application of changes with retrospective application, and a limitation in retrospective application and disclosure. Changes in accounting estimates, apply changes in accounting estimates only on a prospective basis. Errors, limitation on retrospective statement, disclosure of prior period errors. So these are the areas that we have a coverage. Okay. Now, firstly, let us understand what is an accounting policy. Accounting policy is choice of method to follow accounting principle, practice, procedure, and convention. So choice of method to follow accounting principle, practice, procedure, convention, we take it up as accounting policy. Previously, we used to have WDV to straight line method to WDV or anything of that particular sort. We were calling it out as changes in accounting policies. Actually, in India's, they have come to a conclusion that the computation of depreciation is not a policy. We have in India 16 two methods of following amortization we have. One is cost model, the other one being revaluation model. Cost model, the other one being revaluation model. So that can be considered as changes in accounting policy. But methods of computing depreciation cannot be considered as changes in accounting policy. There is no policy change. It is only method of computation undergoing a change. So that being the reason as why you have changes from one method of computing depreciation to another method is not taken up as changes in accounting policy, but changes in accounting estimate. So method of charging depreciation where you have cost model and revaluation model. So change here is accounting policy change. Computation of depreciation, the methods from SLM to WDV. Such change is changes in accounting estimate. Say, I'm just giving you a fair idea about what you need to do. When there is a change in accounting policy, you should do it on a retrospective basis. Whereas changes in accounting estimates, you will do it on prospective basis. To be done on prospective basis. Then we are talking about errors. Previously, we used to have an item in this fashion. Errors should be understood as related to one or more previous years, affecting current year, arising out of error or omission. Arising out of error or omission. So here we would like to add two more points to it. What are the two more points that we have? It includes intentional error. That is fraud. So related to one or more previous year affecting current year arising out of error or omission include, this is errors include intentional error, that is fraud. So neither retrospective nor prospective. What do you mean by that? Adjust in the opening retained earnings, not to affect current year P&L. Okay. Errors related to one or more previous year affecting current year arising out of error or omission include intentional error, that is fraud, neither retrospective nor prospective. That is adjusting the opening retained earnings, not to affect current year's profit and loss account. This is what we need to understand from error or omission. Now let us just take up a problem to know us how to crack them. So book back, we can straight away take it up. A carpet retail outlet sells and fits carpet to the general public. It recognizes revenue when the carpet is fitted, which on an average is 6 weeks after the purchase of the carpet. It then decides to subcontract the fitting of carpets to self-employed fitters. It now recognizes revenue at the point of sale of the carpet. Whether this change in recognizing the revenue is change in accounting policy as per provision under Ind AS 8. See, first and foremost thing in any problem involving case study, I'm just telling you that you got to go by 4 steps model. Step number 1, step number 2, step number 3, and step number 4. Step number 4 is always to go for conclusion, discussion. In step number 3, discussion. So we are expected to go for invoking the provisions. First one is introduction. To which accounting standard this one is affecting and all that. Introduction, invoking the provision, discussion, and then lastly, conclusion. These are the 4 steps that you are expected to take up for any case study for a discussion. Now let us just look into as what exactly was the question. A retail outlet sells and fits carpet to the general public. So a carpet dealer, what he does is that he sells and fits the carpet to the general public. It recognizes when the carpet is fitted, which is on an average is 6 weeks after the purchase of carpet. So there are 2 things that you have. One is you are selling the carpet, the other one is you are fitting it. Right. So should I recognize the revenue after fitting, or should I recognize upon, that is, should I recognize after 6 weeks that being fitting, or should I recognize at the point of sale, that is the moment the sale is made? So it then decides to subcontract the fitting of carpet to self-employed fitters. It now recognizes revenue at the point of sale of the carpet. Whether this change in recognizing the revenue is a change in accounting policy as per the provision of Ind AS 8. Is it a policy change? So as far as the customer is concerned, when you demand for money, they would just pay the money only upon completion of the work. So whether you are carrying it out of your own or giving it to a subcontractor and finishing it off is no matter for you. When you have taken up the responsibility where that control, ownership, etc., not delivered would mean, and at the same time, the customer is not deriving any amount of benefit when it was partially completed. So can you consider this change as change in accounting policy? So let us just go about as how we can, or how institute has just developed this solution. Now let's just see that. Sorry. This is not a change in accounting policy, as the carpet retailer has changed the way that the carpet was fit. Therefore, there should be no need to retrospectively change prior period figures for revenue recognized. So it is not a change in accounting policy. It is only the change of style of business. Instead of doing of your own, you have done it through somebody else. So it is only the change of doing the business in a different way. So I would like to put it in this fashion. So point number one, say, though they have not put in the form of step number one, so we can as well take it up in this fashion. Number one, discussion. Say sometimes you can cut short 2-3 steps together and you can make it out in one form. Company delivers and agrees to fit the carpet to the customers. It takes 6 weeks to fit the carpet. Instead of doing directly, the company now changed the style of conduct of business. It subcontracts the work to fitters directly. 2. Is this construed as policy change? Policy change? No. It is only a change in the approach to effect the sale. So is this construed as policy change? No, it is only a change in the approach to effect the sale. A strategy change in conduct of business is not a change in accounting policy. So, hence, revenue shall be recognized only after the fitting is complete, either done directly or through subcontractors. Right. So hence revenue shall be recognized only after fitting is complete. This will not fall under Ind AS 8, and the company need to follow strictly for recognition of revenue Ind AS 115. That's it. So 5 steps that you are expected to take it up. So the company delivers and agrees to fit the carpet to the customers. It takes 6 weeks to fit the carpet. Instead of doing directly, the company now change the style of conduct of business. It subcontracts the work to fitters directly. Is this considered as a policy change? No, it is only a change in the approach to effect the sale, a strategic change in conduct of business, not a change in accounting policy. Hence, revenue shall be recognized only after fitting is complete, either done directly or through subcontractors. This will fall, this will not fall. This will not this will not fall under Ind AS, and the company need to follow strictly for recognition of revenue Ind AS 115. This is the way we are expected to take it up. Now let's see as if there were to be anything else that we can take note of. So I think we will take up question number 3, which is considered to be a little good in size. So maybe attracting the attention of the paper sitter. Now let us just do that. During 20X2, Delta Limited changed its accounting policy from depreciating property, plant and equipment so as to apply much more fully a component approach while at the same time adopting revaluation model. In years before 20X2, Delta Limited assets records were not sufficiently detailed to apply a components approach fully. At the end of 20X1, management commissioned an engineering survey which provided information on the components held and their fair values, useful lives, estimated residual values, and depreciable amounts at the beginning of 20X2. However, the survey did not provide a sufficient basis for reliably estimating the cost of those components that had not previously been accounted for separately, and the existing records before the survey did not permit this information to be reconstructed. Delta Limited's management considered how to account for each of the two aspects of the accounting change. They determined that it was not practicable to account for the change to a fuller components approach retrospectively. So, or to account for that change prospectively for any earlier date than the start of 20X2. Also, the change from a cost model to evaluation model is required to be accounted for prospectively. Therefore, management concluded that it should apply Delta's new policy prospectively from the start of X2. Additional information, tax rate 30%, property, plant and equipment at the end of X1, cost 25,000, depreciation 14, net book value 11,000, prospective depreciation expenses, old basis 1,500. Some results of the engineering survey, valuation 17,000, estimated residual value 3,000, average remaining assets life 7 years, depreciation expense on existing property, plant and equipment. Under new basis 2000, you are required to give relevant note for disclosure in Ind AS 28. So understand that it is not a question on computation, it is a question of discussion there. So now let us just take up that particular part. From the start of X2, Delta changed its accounting policy from depreciating PPE so as to apply much more fully a component approach while at the same time adopting revaluation model. See, I hope that all of you would be knowing about component model. What is a component model? If you have an asset which has got different components to it, for example, in the case of a flight, you just understand that the flight will be having something like engine as a separate item, which will have its own useful life, and a rough exterior. You would be finding that has got to lost, taking into account the pressures of external environment, etc. The other one being the soft interiors where they got to handle the passengers, or if it were to be cargo, so the protection that it has to undergo there. So there are 3 components that you have. So with different lives, and you call that as one unit as an aeroplane or an aircraft. So when you have these 3 components, you are expected to charge depreciation separately, taking into consideration the useful life, different useful life, different salvage value, and so on. So that is what we call it out as what? Component approach. So now keep that in your mind when we are discussing or reading out through. Management takes the view that this policy provides reliable and more relevant information because it deals more accurately with the components of PPE and is based on up-to-date values. So the policy has been applied prospectively for the from the start of X2 because it was not practicable to estimate the effects of applying the policy either retrospectively or prospectively from the earlier date. So that is what they have just indicated. See, the problem is about how you are going to give the disclosure. Accordingly, the adoption of the new policy has no effect on prior years. The effect on the current year is to increase the carrying amount of PPE equipment at the start of the year by 6,000, increasing the opening deferred taxation by 1,800 by keeping the tax rate at 30% and the revaluation surplus of the start of the year at 4,200, increase depreciation expense by 500. That is the difference between the 2,000 and 1,500, and the reduce the tax expense by 150 by applying this percentage of taxation rate of 30%. So this is what you are expected to provide as your note there. So disclosure and notes as how you got to make presentation is more important. See, many a time students take it up a little easy and they do not focus on how to make a presentation. So with that, I would consider that Ind AS 8 is getting over. So we understand 2 got over, 8 got over, 19 we have got, that is we have done it, and now 24. So related party. So now let's just go through one we have just done in the very first class, 7 the cash flow, 10 events occurring after reporting period, 12 we have just got towards deferred PPE, government grants, 23 borrowing, EPS, borrowing cost, EPS 34, interim financial, 36 impairment, 37 provision, 38 intangible, 40 investment in property, 41 agriculture. So 102 for share-based payment, 103 non-current asset held for, business combination, 105 non-current asset held for sale, and 108 segment, and these things on consolidation, 115 revenue recognition, 116 for modification, and 107, 109, and 32 we have taken up under financial instrument for consolidation, 28, 111, and 112 taken as part of the consolidation, 2, 8, and 19 got over, and as the last one, 24, we will take it up for related party disclosure. So apart from that, then we have 101 that we will take it up. So what is that we do have in the case of related party transaction? See, all of you, please understand that transactions are of two types. One is related party transaction and other than related party transaction. Related party transactions are not at arm's length price, not at arm's length price. So this one will be at arm's length price. So have that in your mind that whenever you have a transaction with related party, general belief, I'm talking about the general belief. It is not necessary that in all cases, not at ALP. One moment. Not at ALP in all cases, but the general belief is that belief is not at ALP, and the general belief when transaction is between other than related party, we will take it up as at arm's length price. Okay, so now when you have in your transactions list, transactions with the related party would mean the reliability of see how to bring about when you have a transaction with related party. See, you can't avoid related party transaction at all. See, in a business world, you just find so in a business world, you can't avoid doing business. You can't avoid doing business with related parties. Related parties are formed to bring about convenience in the transaction, and the convenience could be in variety of forms, right? So the convenience could be in variety of forms, correct? So one cannot avoid transactions with related party. So therefore, the reliability of the financial statement will take a beating. When it is not at arm's length price, the reporting entity would have benefited at the cost of related party, or the related party would have benefited at the cost of the reporting entity. Between the two, one would be appropriate. So how to bring about reliability? So you can't avoid transaction with related party, and we cannot be a silent spectator when this related party transaction is causing erosion in the reliability on the outlook of the financial statement. We are expected to improve the reliability despite continuing to be party to related parties or transacting with related parties. So what is the best way of doing things is only to report. Report of related party and a transaction. Report of related party and the transaction. Report of related party and transaction shall improve upon the reliability. Report of related party in the transaction shall improve upon the reliability. So please just understand, a report of this will improve upon the reliability. Now, we need to know now what is a related party. Who are all related party? What are all the related party transaction? And what is the disclosure to be made? So what is a related party? Who is a related party? What is a related party transaction? Disclosure to be made. So all these we are expected to bring about. All these we are expected to bring about a lot of discussion. Related party comes out of two things. One, through significant influence. The other one, through control. So related party transaction arising out of significant influence, the other one being out of control. Correct? So disclosure when you are, there is when significant influence and control when you have. Now the question is that I do have a scenario in this fashion. I have relationship, significant influence and control. I have this, but I don't have this. And I have related party transaction. Now, what is that I am expected to do? I have related party relationship under significant influence, but I do not have the control, but I have transaction during the related party relationship. So what is the status? Status is that we got to disclose related party and a transaction. So this is combination one. Combination number two, related party relationship. I have significant influence, but I do not have control. And I also do not have related party transaction. What is the status? What is the status? Should I disclose anything? No disclosure is required. No disclosure is required. Why? So when you are having a related party relationship under significant influence with no transaction, nothing is expected to be disclosed. So that is the reason as why I thought we will separate all this. Next one, related party relationship where you do not have under significant influence, I have control, I have transaction. Then what is it? So disclose related party relationship under transaction. 4, I have no under SI, yes under control, no under transaction. What is that I am expected to make? So here we have just made a note that it is disclosure, disclosure. So here we say no disclosure. What is that we are expected to do? So here we are expected to disclose. Disclose what? When there is no transaction, related party only. So when there is no transaction, even though I do not have a transaction, when the relationship is falling under control, I am expected to report this matter, the related party relationship. So the matter is a very simple matter. See, people might just have this feel, sir, 2 and 4 are lookalike. 2 and 4 are lookalike because in both the cases, you do not have the transaction. So when you have the related party relationship under significant influence, you say nothing is required. Whereas for the similar scenario, you say disclose the related party relationship. But in order to strike a similarity, here also we could have just done, no, I am expected to disclose the related party relationship, but it is not that way. So whenever we have a control, control will have more influence or better sort of influencing abilities than when it is simply a significant influence. So I will put it this way. I normally give the same example. Imagine, imagine a scenario where Madam Jayalalitha was the chief minister, right? So many people know that she is belonging to a particular community. And if I make a statement that she was my cousin, imagine that I'm making one statement. See, because I'm not taking somebody else for example, I'm taking myself as example. So I just go to, or I'm caught by a cop. Let us assume that, you know, for not waking, there is wearing helmet or not putting the seat belt on. So the person is just asking this. So I'm telling to the cop saying that she's my cousin. I'm just going there to meet her. She has got a very important appointment. So I'm just putting my mobile DP, her photo only. Let us assume that it is like that. So what the cop will definitely be thinking, oh, he is related to the chief minister and he is going to proceed for Poyes Garden to meet her. So whether he will be very strict in applying the rules of the road, traffic, and book me for the violation, or he will allow me to go. In majority of the cases, he will allow me to go. I'm not talking about a very strict hero in the movie. So practically speaking, that person would just have a feel, okay, I wanted to see the chief minister. Can you just, on your way back, can you just give the photograph of chief minister? So that sort of inquiry only they will be making. Or I just go to an RTO office where I want to renew my license, where I go to some other place in government setup. See, for example, where I want to go for land registration, flat registration and all that, where I tell to the sub-registrar saying that he is my relative. And I just approve 2, 3 statements saying that she will do whatever I'm just suggesting. Say, I'm just giving you an example. So there need not be a transaction between myself and the chief minister, but the growing influence on her might put me in an advantageous position and where I can make profit. There need not be a transaction between the entity and the related party, but being under a control or having the control relationship will give a lot of advantageous position, and thereby this particular related party relationship itself is expected to be disclosed and need not necessarily have a transaction between the reporting entity and the related party. So I don't have to have a transaction between myself and the madam. So by quoting that I am the relative, very close relative, first cousin, whatever it may be. But actually it is not so. I'm just giving you an example. She's belonging to a different generation. So imagine that when you are telling the relationship where they are coming under control, so one can exploit the relationship for the benefit. So that is the reason as why even when there is no transaction, we are expected to disclose. So let's know about where exactly we can have this question taken up. Let me just check up. Yes, we do have. And even the key management personnel also, whose entities which are under the control and significant influence will also become the related party. Okay. So now let us just try. So from the very first page onwards, let me just show you that related party, related transaction, not a related party, name of the related party, only when there is a transaction, only when there is a related party transaction. Okay. So those issues are taken up. So don't ignore these accounting standards. So please give good amount of importance to all the aspects of this particular accounting standards. And now let us just take up a problem. So I would like to take up one illustration. Entity P Limited has a controlling interest in subsidiary SC and SB Limited and SC Limited. SC Limited is a subsidiary of subsidiary SB Limited. So that means a sub-subsidiary, and a P Limited also has a significant influence over A1 and A2. Subsidiary SC Limited has significant influence over A3 Limited, examining the related party relationship. So we are expected to put them into there is a form of matrix, and through the matrix we should be in a position to answer to this question. So instead of putting it out in this fashion, so I would like to tell that so parent, subsidiary, SA, SB, SC, then A1 and A2. P, SA, SB, SC, A1, A2. Correct. So in the form of matrix, when you put a company to itself cannot be a related party. So when I say a related party, it should be an outside party, even though they may be within the group. So P2, SA, SB, SC, and A1 and A2. So they are all related party because control is present. So subsidiary of the subsidiary is also a subsidiary of the parent related party. So these are all coming under what? They are coming under control, right? So P2, A1 and A2, there where you have significant influence, significant influence. So let me take up another color. So what they have just started doing it. In a separate financial statement, P Limited, SA, SB, SC and A1, A2, A3 are all related parties. So even A3 also they were mentioning. So I forgotten to take up A3 also. So what is that about A3? Which is an associate of A3. Significant influence. So SA to P related party, co-subsidiaries, they are coming under a common control related party, and they are all coming under related party. Just see as how they have mentioned in the individual statement of SA Limited, P Limited, SB Limited, SC Limited, A1, A2, A3 are all related parties. Correct? So instead of answering to this way the question, you put them in the form of matrix, you will be in a position to take them together. Say now, when we are talking about in the books of P Limited, SA, SB, SC, in the individual statements of A1, A2, A3, P Limited, SA Limited are all related parties. Correct? A1, A2, A3 are not related to each other. So, co-associates are not related parties. So, it should be a relationship between investor and associate. But two associates on them, there is no significant influence. You do not bring them as part of the common control. Only for control, you have common control. You do not have common significant influence. So that is the reason as why A1, A2, A3 are not related parties. So have that in your mind that when you are talking about parent, a subsidiary on individual basis, all are related parties because they are all coming under control. And if one is in a position to exercise the significant influence, the same is applicable to the other companies within the group. So in individual financial statements of A1, A2, A3 Limited, P Limited, SA Limited, SB Limited, SC Limited are related party. So please always remember for A1, this is related party, SA related party, SB related party, SC related party, then it will not have for A1, these are not related parties, not related parties, not related parties. That is what they have mentioned. A1, A2 and A3 are not related to each other. So same subject matter only they have repeated. So related party, related party, related party, related party, not related party dash not related party. So related party, related party, related party, related party, not related party, not related party, and dash. So here we can also complete that. No big deal. Related party, related party, related party, significant influence, and significant influence. The subject matter is over, right? So all this, when you carefully go through, you will be in a better position to crack them all in no time. So just go prepared for these sort of topics where you don't have to remember any template. If you understand the concept well, then you can easily crack them. So I would just see that way. Ind AS 24 is getting over. Now, the one and only item that we have not yet taken up is 101 first time adoption. Now, let us just take up first time adoption. FTA. So, the company which is effecting the change from the existing legacy system to Ind AS, we will take them under first time adoption. And one more thing is that when you take up the first time adoption, it is, say, for example, if it were to be on 1st of April 16, is the first time adoption. So we are not expected to change for that particular year alone. Even the comparatives of the previous year, where you got to take it up 1st of April 15 onwards, you got to take it up. So now the first India's reporting period, I just giving you an example there, and against this problem, against this particular topic, we will solve two problems. Say many a times students ignore certain accounting standards for variety of reasons which I do not know. Now let us just take up first Ind AS reporting period. The latest reporting period covered by an entity's first Ind AS financial statement. XYZ Limited is a BSE listed company having a net worth of rupees 100 crores. XYZ Limited has to prepare financial statement as per Ind AS from 1st of April 20X1. The first Ind AS financial statement would be for a period ending 31/3/X2. First time adopter XYZ with effect from 1/4/2000X1. Opening Ind AS balance sheet will be by 1st of April 20X0. Date of transition to Ind AS is 14X0. First Ind AS reporting period is 14X1 to X2. The financial statement for the period from 14X0 to 31/3/X1 shall be comparative period for the first Ind AS reporting period. So the first transaction, the date of transition to Ind AS is not 14X1, that will be taken up as 14X0, right? So one more important thing that you should remember is that, so in their financial statement, they are expected to disclose that they are adopting it for the first time. There can be entities where they would have adopted for the first time, but when they have not disclosed or when they have not made a claim to the outside world about their first time adoption, they will not be taken up as a first time adopter. So a company which is disclosing, a company which is making an claim that they are adopting, only that company will be taken up as first time adopter. When a company had really done okay, let me just put it this way. When a company had in fact adopted first time but failed to make a disclosure, then they will not be considered as first time adopter. See, I will put the case like this way. Where people used to communicate in this fashion, substance over form. Which one of the two is to be given importance? Generally, people say it is substance should be given greater amount of importance than the form. So now I would like to one moment. So in a movie, cinema movie, see, you should be in a position to know it. So it got released in the year 2000, that being Alai Payude. See, in Alai Payude, what will happen is that because of the frequent talks between two lovers, it resulted into a very urgent moment for them to get married. So for one particular spurt of the moment, they have decided that they will get married, and they will get them married, or they will get married in a registrar's office, but not like a traditional marriage. So you find where the marriage was not performed in a traditional way. They got married, but they could not celebrate it. Celebration was done only with a small circle of their respective friends. But these two couple went to their respective homes, and one is working, the other one is a student, medical student. So if you were to be the neighbor of that hero Madhavan, whether he is a married fellow or not a married fellow, he would have carried out his marriage registration, but it was not announced to the public. And therefore, as an unknown neighbor, you would only tell that he is a bachelor. Same is the way if you were to be the neighbor of Shalini, and when a question is asked, it's all imaginary, okay? So where somebody is asking what is her status, you would definitely tell she is a single, not married, eligible girl for marriage. But if you ask a question whether she is married, definitely yes. She is married, but it is not known to you. When it is not known to you, because it was not publicized, you say that they are not married. Same way, I have made adoption in my books of accounts, but I have not made a declaration. So therefore, I am not a first-time adopter. So therefore, in this particular case, substance fails, and what you find is form is winning. So that is the reason as why in marriage, all these rituals and showing off are very, very important. That is the reason as why they take a lot of photograph, videograph, and they share this information to all. Whether they are really loving between them or not, nobody is just checking. So it's all happening like that. Marriage is like that. So that particular example, I will just see. The other example, a little older movie, older to my times even. There was one particular movie by name Missy Amma. So where unemployed graduate being Gemini Ganesan and unemployed girl Savitri. Both of them were unemployed, but they got one particular employment opportunity where in a remote village, they have a school where the school correspondent had bad experience of having teachers leaving the village quite, what should I say, shortly, or the turnover is very high. People joining and leaving, because a bachelor may not be having adequate or big life in a village, nor the girl. So he had put a condition in the advertisement saying that only married couple and they should be teachers. So therefore, only so the correspondent had put a condition that the teachers should be married people. They should be married and they should be husband and wife. So the hero would be asked, there is asked, the hero was just questioning or was just asking the heroine as why not they pretend to be married before the correspondent, and so that they get into employment, and their real intention is not to get married, and they belong to different faiths also. Firstly, she will protest, and she would be asking a lot of bad questions to him as what is your real intentions. Such an employment do you require by telling a basic lie on a marriage faith, marriage and having people in different faith. So then he will leave it off, but the pressure on the girl's side would may change her mind, and both of them will project themselves as married. In fact, they are not really married. So if you ask a question as whether they are married, both of them declared that they were not really married. So which one is given greater importance in marriage is not the substance, but the form. So whenever you are in search for giving an example, marriage is a right example where you can tell that substance is sidelined and the form is given the big projection. So that is what you have it in this particular accounting standard. So I would like to tell you that which one is an first time adopter. First time adopter is that particular entity which makes an unreserved disclosure that they have just done this. Now, let me just show you that. I think it has just gone in the first few page itself. So the first annual financial statement in which an entity adopts Ind AS by an explicit and there is an unreserved statement of complaints with all Ind AS. This means complaints with all Ind AS. Partial complaints is not enough to make an entity Ind AS complaint. That means it should be 100%. There is no negotiable portion that you have that I have not adopted one accounting standard. It may not be an accounting standard would be applicable to you. So you may not have an interim financial reporting not applicable to you. So you would not have taken up. That does not mean it is a non-compliance. We have got to be very careful. So an entity that presents its first Ind AS financial statement, that entity is known as first time adopter. So opening Ind AS balance sheet as entities, there is on the date of transaction to Ind AS. Okay. So date of transaction and Ind AS. So the problem that we will be taking up in this particular section is going to be a little bigger. So therefore, I would like to take a break at this moment, and maybe 10-15 minutes we can take it up as a break, and then we will take up on to two problems on Ind AS 101. Then I want to take up one problem on consolidation. I think by that point of time, we will be coming to an end of this session. And so before I could just forget, let me just thank SICASA for giving an opportunity to interact with you. And we will be meeting 15 minutes later from now on. Okay, thank you. Yes. So we shall resume. See, now let us just resume our work. What sort of changes that we got to make by solving the problem, we'll be in a better position to understand rather than going by different stages. So these problems are financial instrument problems only. With what we have just done, we do have. So whenever you study for this particular topic, you please study at the last. Now let us just take up illustration number 16. H Limited has the following assets and liabilities on 31st of March 20X1 prepared in accordance with previous GAAP. So property, plant and equipment, 1 crore and 34 lakhs and 50,000. Investments in S Limited, 48 lakhs. Trade receivables, 2 lakhs. Advances for purchase of inventory, 50 lakhs. Inventory, 8 lakhs. Then 49,000 towards cash. Total assets, 2 crore 42 lakhs 99,000. We have VAT deferral loan schedule 360 lakhs, creditors 30 lakhs, short-term borrowing 8 lakhs, provisions 12 lakhs, 110 lakhs. Share capital of 130 lakhs, reserves 299 lakhs, cumulative translation difference of 1 lakh. ESOP reserve 20,000, and you have retained earnings there to the extent of 1 lakh and 79,000. Total equity comes to 1 crore 32 lakhs 99,000. And total equity and liabilities 2 crore 42 lakhs 99,000. The following gap differences were identified with the company on first time adoption of Ind AS with effect from 1st of April 20X1. That is, whenever we try adopting, we need to adopt such adoption should be done on a retrospective basis. And there are some declaration that they can take up. Now let us just try. In relation to property, plant and equipment, the following adjustments were identified. Property, plant and equipment comprised land held for capital appreciation purposes costing 450,000 was classified as investment property as per Ind AS 40. Exchange difference of 100,000 was capitalized to depreciable property, plant and equipment, which on which accumulated depreciation of 40,000 was recognized. There was no asset retirement. The management intends to adopt deemed cost exemption for using the previous GAAP carrying value as deemed cost as at the date of transaction for PPE and investment property. The company had an investment in S Limited, subsidiary of H Limited, for 48 lakhs. That carried a fair value of 68 lakhs as on the date of transaction. The company intends to recognize the investment at its fair value as on the date of transaction. Financial instruments, VAT deferral loan 60 lakhs. The VAT deferral loan of 60 lakhs was obtained on 31st of March 20X1 for setting up a business in a backward region with the condition to create certain defined targets for employment of local population of that region. The loan does not carry any interest and is repayable in full at the end of 5 years. In accordance with Ind AS 109, the discount factor on the loan is to be taken up at 10% being the incremental borrowing rate. Accordingly, the fair value of the loan on 31st of March X1 is 37 lakhs 25,528. The entity chooses to exercise the option given in para B11 of Ind AS 101. That is, the entity chooses to apply the requirement of Ind AS 109. Financial instrument and Ind AS 20. Accounting for government grant and disclosure of government assistance retrospectively as required information has been obtained at the time of initially accounting on VAT deferral loan. Then the retained earnings of the company, ESOP reserve, the company had granted 1,000 option to employees, out of which 800 has already been invested. The company allowed an intrinsic value method for recognition of ESOP and recognized 12,000 rupees 12,000 towards vested option and 8,000 over a period of time as ESOP charge and a corresponding reserve. The fair value has been followed in accordance with 102. The corresponding charge would have been 15,000 and 9,000 for vested and unvested respectively. The company intends to avail Ind AS 101 exemption for share-based payments for not stating the ESOP charge as per previous gap for vested options. Cumulative translation difference 1 lakh. The company has a non-integral foreign branch in accordance with the AS 11 and has recognized the balance of 1 lakh as part of reserves. On first time adoption of Ind AS, the company intends to avail Ind AS 101 exemption for resettling the cumulative translation difference to zero. Prepare transaction date in the AS balance sheet of H company showing adjustment to the values of assets and liabilities. See, it's a fairly very good program. So straight away, I would like to take up this sort. What is this sort? We will read the problem. We will take up in Excel these computations and try doing it. Okay. So now let me just try this. See, many times is not, I consider that by taking up institute material as a base and solution can be drawn in Fastrack class. But when we try it out for a normal class, we don't require that because here time is a constraint. No. So therefore I will take up the institute material as a base, but we will do like, so transaction date Ind AS balance sheet. As on, the date is 1st of April X4, X1. So what are the items that you will be having? Previous gap, adjustment, Ind AS. Previous gap, Ind AS adjustment. Then, or adjustments we can call. Adjustments. Then Ind AS gap. So this will previous gap. So item by item we shall take. So property, plant and equipment, 1 crore and 34 lakhs and 50,000. So item number 1, they've said property, plant and equipment comprising land held for appreciation, 450,000 and classified that as under Ind AS 40. Next, exchange difference of 1,000 were capitalized to depreciable property, plant and equipment on which accumulated depreciation of 40,000 recognized. No asset retired obligations that you have. The management intends to adopt deemed cost exemption for using the. So this is what, so we don't have to trace back. So we can adopt the previous figure. So this is what practically we have also carried out. So intends to adopt deemed cost exemption for using the previous gap carrying value as deemed cost as on the date of transaction for PP and investment in property. So therefore, what we have as 134,500. So property, plant and equipment, 1 crore 34 lakhs and 50,000. So here, what is that we are expected to do? We are expected to deduct investment in property to the extent of 450,000 or 450,000. minus 450,000. So therefore, we are expected to arrive at the new value. So investment in property previously 0. Now that you have this, and it is 450,000. So this is what we understand. Let's go through and find out what exactly they've done. So this was shown with negative and this had just come, right? So they were having some item of, see, let me just check up. Exchange difference of 1,000, 100 lakhs were capitalized to depreciable property, plant and equipment, on which accumulated of 40,000 was recognized. So exchange difference was capitalized would mean, so let us just go through for item number 4. See, that has got nothing to do with this. So exchange difference of 1,000 was capitalized to depreciable property. See, it may be an application of Ind AS 23. Exchange difference to the extent of borrowing cost shall be capitalized. So, which they have done already, which is also in line with the present practice that you have. AS 16 and Ind AS 23 are almost on the same lines, and on which accumulated depreciation we do have. So now let us just put a note for that. So here should be as the company is previously deemed all cost. Say they're not mentioned it properly. So we will provide a note for that. So please just don't worry about that. So with that, this is getting over. There is no retirement. So now I would like to take up a matter related to, it is not translation difference. They are talking about exchange difference. So here I will be making note. We will adopt this a little later. So investment in Yes Limited. Now let's go through note number 2. The company has made an investment in Yes Limited subsidiary company for 48 lakhs that carried a fair value of 68 lakhs on the date of transaction. The company intends to recognize the investment at its fair value on the date of transaction. On the date of transaction, instead of 48 lakhs, we are expected to take it up at 68 lakhs. Now let's just go through as how we adopt this. So we have investments there to the extent of originally 48 lakhs. Now we are booking it at 68 lakhs. So we will redraft the balance sheet a little later. So we will go by the order. So investment in subsidiary 48 lakhs, 20 lakhs adjustment, and we are expected to take it about 68 lakhs. So they have placed that in the form of a normal balance sheet itself, whereas I'm just taking it up as a trail balance only. In the same order, I'm just taking it up. Trade receivable, there is no adjustment for trade receivable. Advance for purchase of inventory and cash balance. So we will simply be copying these items from the text. Trade receivables, advances for purchase of raw material, I think so. Purchase of inventory, then inventory, then cash balance. So now let us just take up those numbers. Trade receivables, 2 lakhs, then 50,000, 8 lakhs, then 49,000. So in all these places, 0 is what we are expected to adopt. Okay. In one shot, we have finished off these items. So regarding VAT deferral loan, note number 3 is there. So this is something to do with government grant adjustment that we are expected to carry out. VAT deferral loan. See, in AS 12, as per the old one, this sort of deferral loan were not considered, whereas this is to be considered under Ind AS 20. VAT deferral loan 60 lakhs. The VAT deferral loan of 60 lakhs was obtained on 31st of March X1 for setting up of a business in a backward region with a condition to create certain defined targets for employment of local people of that region. So the loan does not carry any interest and is repayable in full at the end of 5 years. In accordance with Ind AS 109, the discount factor on the loan to be taken up at 10% being the incremental borrowing rate. Accordingly, the fair value of the loan as on 31st of March X1 is 37 lakhs 25,528. That means the present value of the future thing, if you adopt 5 years later, let me just see. So 1 divided by 1.1. 5 years later, 1, 2, 3, 4, 5 multiplied by the loan amount of 60 lakhs comes to 35, 25, 528. Correct. So that is the present value of the future amount that they have got to pay. So the difference between the deferral loan and the present value will be taken up as government grant. So the entity chooses to exercise the option given in B11. The entity chooses to apply the requirement of 109 financial instrument and Ind AS 20. See, now let us just show that computation. So now let us just take up A number 1, 2, 3, 4, and 5. The present value factor is 10% we have to take up. 1 divided by 1 plus. So I am taking it up with 4 decimal value. The cash flow, when I have to adopt, it is 0 for all these years. And in this particular case, it is 60 lakhs. Correct. See, now let us just know about the values that we will be taking it up here. Present value of cash flow. So it is 325, 400. That is what they mentioned here. 325, 528. So since I have restricted this to 4 decimals, imagine that I have not done this. And with no rounding off and all that, when I have. So without any restriction, if you take up, it comes to 37 lakhs 25,528. That is what they have just given. Okay. Now, the journal entry would have been debit So where the loan amount, so it is cash given, let us assume. It is 60 lakhs that you have received. Credit is to be given to loan for this much of money. The balance amount should be taken up as government grant. The difference between the amount what they have received to the present value of the amount. So this much you should take into consideration. So now let us just take up the government grant into our system. So VAT loan is to be given in the problem at VAT loan is taken up at 60 lakhs. Under that, government grant is there to this extent, and the VAT land is this much. Next comes government grant. So government grant is booked now at this stage. Now let's just see as how it is stated in the solution. Yeah, VAT loan, as how it is stated, we have it in this liability side. So I'm not just going by this institute balance sheet directly. I'm just going by the same order in which it is stated. So creditors, short-term borrowings, provisions, share capital, all these are taken up the same way as it was just done in the old one. Government grant, now let us just take up. After that, we will have creditors, short-term borrowings, provisions, share capital, reserves. So let's just take up one by one. Creditors, $30 lakhs. 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 Share capital. So up to this stage, we have just booked. Correct. So we have come to the stage of share capital. Now let's just see how they have just done. So share capital. So all these are taken up in one go. So we have taken up trade payables, short-term borrowings and provisions in one go. Correct. Now share capital was taken up. Cumulative transition difference. This item for which we have an adjustment to that effect. So as per NDAS D12 of NDAS 101, as per para D12 of NDAS 101, the first time adopter can avail an exemption regarding requirement of NDAS 21 in context with cumulative translation difference. What is that we have? If a first-time adopter uses this exemption, the cumulative difference of all foreign operations are deemed to be zero. So on the date of transaction, in that case, the balance is transferred to retained earnings. As much as 100,000 can be transferred to retained earnings. So therefore, we are not going to take it up. See, there you have an option of carrying it forward, and you can knock it off for the remaining period, or you can knock it off in one shot itself. So that is what they have given here also. So 1 lakh, the company has a non-integral foreign operation with AS11 and as recognized as part of the reserves. On first time adoption, the company intends to avail 101 exemption, resetting cumulative difference to zero. So we are given the instruction in the problem that we are expected to carry out this operation in this fashion only. This reserves, we will take it up towards the end, 299. So that is the only item, cumulative translation difference. Cumulative translation difference, you have to the extent of 1 lakh, and it is going to be 0. Correct. Then after that, ESOP reserve, you have item number 4 once again there. ESOP has granted 1,000 options to employees, of which 800 have already been vested. The company, following an intrinsic value for recognition of ESOP charge and recognized rupees 12,000 towards the vested option and 8,000 towards unvested. That is 8,000 rupees, 8,000 over a period of ESOP and a corresponding reserve. So now we have forgotten what is that figure now, 20,000. So they are giving the breakup of 12,000, breakup of 20,000 or breakdown of 12,000, 20,000 as 12,000 and 8,000 between vested and unvested. The fair value has been adopted with 102. The corresponding charge would have been 15,000 and 9,000 for the vested and unvested respectively. So what is considered as 12,000 is now 15,000. What is considered as 8,000 is taken up at 9,000. The company intends to avail 101 exemption for the share-based payment for not restating the ESOP charge as per the previous gap for vested option. So when we just go out for discussing all that in greater detail, we will not be in a position to solve the problem even. So here they have mentioned in item number 4, Ind AS 101 provides an exemption of not restating the accounting as per previous gap in accordance with Ind AS 102 for all options that are vested by the transition date. Accordingly, out of 1,000 ESOP granted, the first time adoption exemption is available on 800 options that have already listed. As such, its accounting need not be, that is accounting need not be stated. However, 200 options that are not vested at the transition date are expected to be restated at 102 because the other 800 got already vested. So as such, additional impact from 8,000 to 9,000 should be recognized in the opening Ind AS balance sheet. So now let us just see as how it is stated. So on 20,000, there is going to be only 1,000 that we are taking up. So we are expected to make those changes in the retained earnings. So there we will be making those changes. So now just wait for that particular moment to carry out that. Okay. So ESOP reserve. ESOP reserve 20,000. And there is only 1,000. There is a change that you are having. And it is 21,000. We will be taking it up. Is it okay? Now, taking to the next stage. These are the changes. So this 1,000 taken up and that 1 lakh we have adjusted. So totally it is 20 lakhs and 99,000. Let us just wait for the moment there. So retained earnings 179, 1 lakh and that 1,000. Okay. So retained earnings, the only item that is missing. Retained earnings. Let me just check up. The reserves also 299 we have. Let us just see as how they are taken up. Reserves 299. So retained earnings we have to the extent of 179,000. The changes that we have made here, 20 minus 1,000, and here we are expected to make those changes. Plus 1,000. $20 lakhs minus 1,000. I should be getting that figure. Now let me just check up. Yeah. Now I'll tell you what change that we have got to make. There is a fair value increase that you are having 20 lakhs. Then minus of minus we have to take up. When it is minus in another place, it is going to be plus 1 lakh. Then minus 1,000. When it is plus in another place, it should be minus. So now let us just take up. This is going to be 2278. $22.78 we are having. Correct. Now let us just take up the entire thing. So always remember as how things take shape, for which I have one cross verification process. I will let you know what is that. See, the reserves, what they have mentioned as 299 is not a separate item. So it is 1,20,000 and 179,000. That just become 299. So if you total up, that is what I was just checking. What is this? What is this? So this 299 for which they have given the breakup. Please just understand, under reserves, you have these three, correct? So reserve by itself is not a separate item. So have that in your mind. So whatever we have just done is right. How do you know that what we have done is right? So here, I just don't want to take up here. What we will be doing, all of you just follow. So assets and liabilities, both we have totaled up. So this divided by 2 is balance sheet total. Except for that, see here is the total that you have. $262.99. So both asset and liability we have groomed up and added no. So that what we have just done is that, so the total shall be divided by 2. So therefore what we have just done is right. Now these items are to be grouped according to current and non-current, and just watch out as how we can make a presentation. So first time adopted balance sheet as on first of April X1. So asset side, non-current assets, Then current assets, financial, non-financial. Then you have equity and liabilities. Then equity, share capital. Then retained earnings, non-current liabilities, and current liabilities. So now let us just take up one by one. The final figures only we will take up. So PPE, so we will pick it up from here. PPE, then investment in property, right? Then comes investment in subsidiary. So okay. Then we take up current assets, financial, trade receivables, cash 49,000. Inventory, then other current assets, advance for inventory, right? Then equity share capital, Then comes retained earnings. So ESOP reserve. We have VAT loan. Current liabilities under which you have creditors, short-term borrowings and provisions. So the balance sheet is a green. So with this, first time adoption is over. Okay. See all this exchange difference for which you can write notes and you can complete it. So now let us just focus on to consolidated balance sheet where we have some book back questions. Okay. We'll take up that. So therefore, we can take up one on one also getting over. So I thought I will try one more problem. So instead of doing that, we will try a few consolidation problem and we can have a comfortable finish. Extremely sorry. So question number 4, we will take it up. So we have just closed all accounting standards. 35 accounting standards we have covered. One moment. DEF Limited acquired 100% ordinary shares of rupees 100 each of XYZ on 31st of October X1. On 31st of March X2, the summarized balance sheets of the two companies were as given below. PPE, land and building 15 lakhs, 18 lakhs, plant and machinery 24 lakhs, 37 lakhs and 50,000. Investment in XYZ 34 lakhs. Inventory 12 lakhs and 3 lakhs 64,000. Financial assets, trade receivable 598 and 400. Cash 145 and 80. Total 9243, 3994. Equity and liabilities, equity capital, shares of rupees 100 each fully paid up 50 lakhs and 20 lakhs other equity. Other reserves 24 lakhs and 10 lakhs, retained earnings 572 and 890. Financial liabilities, bank overdraft 8 lakhs and trade payable 475 and 174, total being 9243, 3994. The retained earnings of XYZ Limited showed a credit balance of 300,000 on 1st of April X1, out of which a dividend of 10% was paid on 1st of November. DEF has recognized the dividend received to profit and loss account, fair value of plant and machinery on 1st of October. X1 was 20 lakhs. The rate of depreciation on plant and machinery is 10%. Following are the increases of on comparison of fair value as per respective NDS with book value on 1st of October X1, which are to be considered while consolidating the balance sheet. Trade payable 100, land and building 10 lakhs, inventory is 150,000. It may be assumed that inventory is still unsold on balance sheet date and trade payables are also not yet settled. Also assume that the other reserves of both the companies on 31st of March are the same as was on 1st of April X1. All fair value adjustments have not yet started impacting consolidated post acquisition profits. Prepare consolidated balance sheet as on 31st of December X2. So we understand that it is a problem involving no controlling interest. DEF is the parent and XYZ is the subsidiary. 100% wholly owned subsidiary. And the acquisition date is on 1st of October and the balance sheet is to be prepared on 31st of December X2. Then we are expected to go for consolidation by taking into consideration the retained earnings of the subsidiary company. They have reported as 3 lakhs at the year beginning, out of which 10% dividend was declared and the same was taken to the credit of profit and loss account. Here is a place where you got to be very careful. It is the purchase were made on cum dividend basis, and therefore we will not accept a credit to P&L account. We will rectify it by making adjustment to investments account. And here the fair value of the plant and machinery on 1st of October was mentioned as 20 lakhs. Whereas we are expected to find out the expected value on the date of acquisition, compare that with 20 lakhs to find out the changes as involving appreciation or depreciation as the case may be. And we are expected to carry out the additional or excess depreciation on the change values. So you have trade payable, you have land and building given, you have inventories also provided there with changes in the value. And the inventory on which change is made is not yet sold. So therefore that will continue to be there on the date of acquisition also. And also assume other reserves of both the companies on 31st of March are same as that of 1st of April. There is no change in the reserves. Fair value adjustment post acquisition, it's a typical problem on consolidation. Now let's just run through it. So we all know that a problem, question number 4 in book back on CFS, where we have first one cutoff, where we will be noting down date of acquisition, date of consolidation, prior to, post, and percentage of holding and non-controlling interest. So it is 1st of October, 1st of October X1, 31st of March X2, prior 6 months, post 6 months, percentage of acquisition 100 and non-controlling interest being nil. So this is what we have for cutoff. Classification, So we have for reserves and surplus. So reserves and surplus of the subsidiary company alone will be taken up for evaluation. Other reserves, 10 lakhs. Opening, same 10 lakhs. Increase nil. Retain earnings, 820,000. Opening, what they mentioned is that 3 lakhs opening balance, on which the dividend was declared at the rate of 10%. 10% on what? 10% on their capital of 20 lakhs. So 2 lakhs they have dispersed out of that. So opening balance to the extent of 1 lakh only you have current year is 7 lakh and 20,000. First half and second half, because 6 months each we have got to take up. 360,000 each on a time basis. 460 as capital profit, and this will be revenue profit. So for plant and machinery, they have something to say. So fair value of plant and machinery on that being 20 lakhs. Plant and machinery on the closing date, 13 lakhs and 50,000. Plant and machinery closing, 13 lakhs and 50,000. So this may be 90% WDV. Opening would be 100% WDV would be 15 lakhs. Why? Because depreciation they have charged at the rate of 10% is what they mentioned. So if the opening were to be 15 lakhs, by deducting 150,000, your closing balance would have been 1350. What is the estimated book value on 1st of October? It is going to be 15 lakhs minus half of the current year's depreciation. Minus half of the current depreciation on 150,000, half of that is 75,000. 14 lakhs and 25,000. This is valued at 20 lakhs. So that means an appreciation is there to the extent of 5 lakh and 75,000. Appreciation is there to the extent of 5 lakh and 75,000. So 5 lakh and 75,000. So here expected closing WDV would be 20 lakhs minus 10% on 20 lakhs for 6 months period. So 10% on 20 lakhs is 2 lakhs. Half of that is 1 lakh. It should be 19 lakhs. But by considering the closing balance of 1350 and appreciation of 575, 13 lakhs 50,000 plus 575,000, it would be 1925. You would be finding closing balance would be 19 lakhs and 25,000. How come? 13 lakh 50,000 as you find plus 575 that you are appreciating, it comes to 13 lakhs and 25,000. Correct? That comes to 13 lakhs and 25,000. 19 lakhs and 25,000. It should have been 19 lakhs. So excess, that is additional depreciation required is 25,000. I hope that things are clear for you. So let me repeat once again. So your closing balance is, the closing balance is, I will put it a little at the top. So additional depreciation, you can put it here. So let me repeat. Your closing land and machinery is 13 lakhs and 50,000. The opening is expected to be 100% by taking 90% as the WDV, where the depreciation charge is 10%. So 15 lakhs would have been the opening there. Estimated book value on 1st of October, where on 15 lakhs we are expected to charge depreciation only for 6 months period. That comes to 14 lakhs and 25,000. That is to be taken up at 20 lakhs. By doing so, you have 575,000 as increase to be made to the closing balance of 13 lakhs and 50,000. That will result in 19 lakhs and 25,000. So had you taken up the fair value on 1st of July, I'm sorry, 1st of October at 20 lakhs, your closing balance expected should be 19 lakhs. So with only 1 lakh of item to be depreciated. So this would mean 23,000 additional depreciation we are expected to be taking up totally. Now let us just take up the consolidation work here. So the template I wanted to do it pakka here. Date of acquisition. Next one is date of consolidation. Revenue reserve. Revenue profit. Here, equity share capital. General reserve or other reserves. The retained earnings. Then fair value adjustment such as onto plant and machinery, land and building, inventories, trade payable, and additional depreciation adjustment. You will take up 20 lakhs, 10 lakhs, 8 lakhs. Under that, the same. So here, this is going to be 4,60,000. Remember that we have just done that work. 4,60,000 capital profit is this. Fair value adjustment for plant and machinery, you are having that adjustment 575. 575,000. Additional depreciation 0 minus 25,000. Without we further is ourselves forgetting. So we have land and building 10 lakhs. Inventory 150,000. Then trade payable 1 lakh. Since it is liability, I am putting it out in the negative. Is that clear? So here, okay, this is what we have. Percentage of holding is 100. %. %. Net worth investments by parent. How much is the value of investments they've shown there? 34 lakhs. This figure is inclusive of there is dividend less pre-acquisition dividend. How much is the pre-acquisition dividend? We are expected to take up at the rate of 10% on 20 lakhs, 2 lakhs. Minus 2 lakhs. And the same has got to be deducted there. Or in fact, I will put it this way. So the net figure is so our investment is far less when compared to the net worth. So this results in bargain purchases. This minus this. Then SFS of the parent with general reserve there. General reserve there 24,572. 24 lakhs, 572 lakhs. Now let us just take up consolidated balance sheet, the consolidated financial statement. See first figures. Minority interest is going to be 0. So here, consolidated reserves and surplus is going to be 1885 plus 24 plus 687. That comes to 49 lakhs and 72,000. Now let us prepare consolidated balance sheet. Consolidated balance sheet as on 31st of March 20x2. Sorry. PPE, non-current assets, property, plant and equipment, parent, under that, plant and machinery. Parent, parent figure. So first land and building, okay. Extremely sorry. Land and building. Parent figure 15 and 18. 15 lakhs, 18 lakhs. Then comes fair value change. How much is the fair value change? Which we have captured in our computation to the extent of 10 lakhs. So the figure to be taken to the outer column will be 43 lakhs. Plant and machinery. ₹24 lakhs, 13 lakh 50,000. 13 lakhs and 50,000. Fair value change was 5 lakh and 25,000. Remember that number, 5 lakh and 25,000? Sorry, 5 lakh and 75,000. Then additional depreciation, 25,000. So we are expected to make those changes for 30,000. Then apart from that, for this investment, you will take it up as bargain purchase. That will not come there. So current assets, non-financial assets, we will have inventory. Inventory 12 lakhs, 3 lakhs 64,000. 12 lakhs, 3 lakhs 64,000. Fair value change. How much is the change that we have got to take up? So inventory change that you have, that we have captured to the extent of 150. Correct? Inventory, we have financial assets. Trade receivables, cash. $598 and 4 lakhs. The next one is cash. $145 and 80. And we will take amount of equity and liabilities. Equity and liabilities we will take up. Under that, equity share capital only we will take up. Firstly, $50 lakhs. Then consolidated reserves and surplus. Then financial liabilities, where we have for trade payables some adjustment. So let us be careful with that. First one is bank overdraft. Bank overdraft. What are the adjustments that we have to carry out? 471, 174. Then fair value change. So we have made change to land and building inventories. Let me just check up. In inventory, we have made a change. Okay. Trade payable, we got to make change to the extent of 1 lakh. So we have all items taken up there. So there is a difference that you have. $20,000 difference. Let me just check up. Additional depreciation we have taken up. So let me just check up with the numbers that we have taken up. I think that is a place where we would have gone wrong. Land and building, 15 plus 18, 33. 33, added 10 lakhs, 43. Plant and machinery, 240, 1350. 575 is the appreciation. And 25,000. Let us just know about what, yes, assets. Inventory, 12,364. 12,364. Fair value change inventory, 150 added. Trade receivable, 490, 598, 400. 598, 400. 145, 80. 145, 80, 225. Correct. So, equity share capital, right? So, on the liability side, so 820, 720, 460, right? 800, 800. 471, 174. 471, 174. 645 fair value change, 1 lakh. Outer column is this. 20,000 rupees difference we have. Let me just check up with this computation. $460 and 80. I think here is a place where we have gone wrong. This is 820. So there is no difference. So here by mistake I have taken up 8 lakhs. It is 820,000. Okay. So because of the Excel, automatically it takes care of all those changes. And no way we will just have difference coming up in the balance sheet, and it is all properly done. So that's the way we have just completed one such problem on consolidation there. Was question number 4. So on the similar lines that you have, question number 5. With that, we will just put an end. So where we have non-controlling interest coming up there. So I will take 2 minutes break on to this. So there is an urgent thing that I got to do. One moment. See, yes, see, I would like to, there is an, see, at this moment, I would like to conclude because we have a visitor, so it's an urgent work that I got to take it up. So I would like to conclude it like this way. Hmm? So FR is really, yeah, decider or fate decider, I would say. Fate decider. So I'm just giving you a positive outlook only. So when I say as fate decider is that people who have scored very high marks in FR continue to have that streak in advanced financial management as well as in audit. So these three are good scoring points for the next group. Those who are taking up both groups together. So try all the very best and confine only to institute study material and RTP and all that. Okay. Extremely sorry. So we have a very important meeting to take place. That is the reason as why the client was just waiting. So he has got to leave for voting and he has got to finish a work. So unfortunately, I could not just hold the class till 6 o'clock. Okay. Thank you all the very best. And in case of any doubt, you can just have my email ID 12murali at MURALI. MURALI at gmail.com. The other one is that in case you want to take it up, 6383 228202. Only for doubts. So though I run coaching class and all that, I will not use your contact for any promotion purposes. So you just ask. Need not necessarily join our private class, but I'll be very happy to clarify your doubts. Okay. Thank you. All the very best.